There are 10 methods of valuation plus an 11th, which is the pre-revenue valuation. So there are 10 methods based upon companies already in revenue. Number one, multiple of revenues, a very typical way that we do quickly with our, rule of thumb, and that is a half to 4x. I need to quickly explain that for manufacturing companies or companies that have costs that are from outside vendors, we subtract that before we put this multiple on. So if you're doing $1 million of business, but you're paying $400,000 per product from the outside, we only count the $600,000 worth of gross margin that you're making. So it's a half to 4x. If you're a SaaS business, those numbers were as high as 15 times recurring revenues, annual recurring revenues. That has come way back down to the norm, which is about 6x. And you can expect, if you're a recurring revenue company with guaranteed paid contracts of about 6, sometimes 7 or 8 times that annual number as the value of your company. You make your money going in, and that's a very important thing, to have low valuations if you can negotiate them, so that an actual sale, which typically, by the way, in these early stage companies, when they become successful, typically sell from 30 to 40 million. That happens to be the sweet spot for these early stage companies at their later stage. Yes, we've had a $500 million sale recently. We even had a $1 billion sale. But the average of 30 million to 40 million is a good number to remember. If you go in at 2 or 3, you've made more, depending on how many more rounds there were, than 10x. But if you go in at a pre-money of 10 to 12, which was happening for a while, you're only making 2 or 3x, and you're not going to be happy at all. So you make your money going in. All right, let's go to number 2, the price earnings ratio, which you alluded to a minute ago. And this is the price of the stock per share divided by the earnings of the stock per share. You'll find this for public stocks as the main way in which people value public stocks. And that number is 5 to 30 times that ratio, or net earnings. So if you end up with net earnings of $1 million and you're growing at a rate of 20%, just for conversation's sake, you'll probably be able to get a valuation of 12 to 15 times that 1 million, or you'd be worth about $12 million. Just gives you an idea that PE ratio does come into effect for valuation of later stage companies and public companies, of course. Mm-hmm. Number 3, free cash flow. Why? Why would you even talk about free cash flow? This is the amount of cash that the company is generating per year. So let's say that a company generates $1 million of cash after paying everything. This is before depreciation and amortization, is even before interest. So if you made $1 million to the bottom line, your company might be worth between 5 and 8 million. Number 4 is the book value. These numbers decline as I go down through this list, so be aware of that. If you have to sell your company at book value and you're a technology company, so the book value won't be very high for technology companies. On the other hand, if it's a manufacturing company with machines that have been out there on your line for 10 years and the cost of those machines has gone up by 10 times over 10 years, your book value may be extremely low, but replacement, which we'll talk about as number 6 later on, might be very high. So book value is not a good way to sell your company, is what I'm getting at. And in fact, I have had to, unfortunately, liquidate some of the companies that ended up broke. And when you try and get rid of those companies' assets at book value, the technology, which may have cost millions and millions, I have found turns out with most buyers to be worth some uniform number that I keep seeing all the time at $200,000 for all that technology, because buyers just can't make that technology work. So we don't want to get caught in the book value trap, but I've got to put it down as one of the 10 methods. Number 5, liquidation or salvage value. If you're having to call in a auction company to sell whatever you have on the floor, if this be a manufacturing company, this is the lowest possible valuation that you can get. It's the one that you get when you've closed the company and you've sold the chairs and tables for whatever you can get. Not a good number. Number 6, replacement value. This is the one that I alluded to a few moments ago. If you happen to have assets that cost an awful lot of money to replace, let me quickly say that if you have technology that you've written in languages which aren't the current language, that took a lot of time to write, but today, by using AI tools, by going to some of the sources where there is open source, you might end up replacing the very expensive software at a much lower rate. And that's one of the problem opportunities with AI. Your replacement value will go way, way down, which is not good because you want to have barriers to entry from other companies. And the replacement value, if it's low, make that barrier to entry low as well. So the multiples of revenue, just to summarize these first 6, are the most important numbers. And they are negotiable. You said it very clearly. You can, depending on your growth rate, push that up to multiples of current revenues as opposed to the past. And you could even begin to get some multiple with discounted cash flow, our next one you're going to see, based upon future. So here it comes. The next one is similar company transactions, very difficult for early stage companies. Number 8 is recent same company transactions. Be careful about this. If you happen to have an ESOP plan, or you have share sales that you've made and all of them were common shares, for example, you may have just set the price for your company for the short future until you can show growth that came because you made a sale of some shares in one form or another to either an option agreement plan or to your ESOP plan or to some outside investors at a price lower than you'd like to see. But that is the same company transaction that may set your price. Number 9, the internal rate of return. And this would mean that if you can show that your valuation grows at 20% a year and you show 3 years into the future and you want the buyer to pay for that future value, they will at the very least discount the future value by some percentage. Lately, it has been 7 to 10% per year. And that compounds, by the way, to get back to its present value of that future revenue. Okay, and then the last one that you'll get very easily is comparable public company valuations. And here we always do, when we hire an investment banker, research into public companies that look like us, no matter what their size. We take percentages to make them look like us, not necessarily similar dollar volume of transactions or dollar volume of revenue. And we try and compare ourselves to the public companies by using the same percentages, same percentage of net EBIT, the same percentage of gross to net. There are lots of percentages we can try. And so that is what your investment banker will do. And one of the added value components of what an investment banker does, because if you think that you're only valuable to 7 or 8 or 10 companies, an investment banker will tell you that you might be highly valued to a European company that needs to come to the United States, more highly valued perhaps than US buyers. Or maybe they have contacts within the Magnificent Seven that you don't, that would help to increase your valuation. So comparable public company valuations are really important, and having an investment banker who can do this for you and with you is a secondary, very important thing as well. But here we go, number 11. Let's now finally get to what happens with pre-money valuations. So here's the Berkus Method, valuing the pre-revenue business. And this is now important, especially for angels, trying to value these opportunities that come before us before they've even shown any revenue, but they'll project gigantic numbers. Do we use their numbers, the first 10 methods? No. We try and find some way of valuing them based upon something that is other than their estimates of revenue, which 100% never turn out to be real. So, the Berkus Method is known and widely used worldwide and has been by over 1 million entrepreneurs and angels since 1996. I actually invented it a little earlier than that. It was first named the Berkus Method, not by me, but by Howard Stevenson, who at the time was in the business school at Harvard. He wrote a very early book entitled Winning Angels. And he interviewed 7 angels from around the country, and I was one of them. And he was intrigued by this method of valuation I'm about to tell you about. He named it. He put it into the book with that name, and it stuck. It is for pre-revenue companies. It's easy to calculate, as you're about to see. And really, it turns out that the investors benefit because they can do a rule of thumb using this. And the entrepreneurs benefit because they have an idea of what they're worth before they get it in front of the investors. Now, if I've gotten your attention, here it comes. If you look at this, and you can't see it very well, it says about 314,000 responses. If you look up the Berkus Method on Google, Google used to list every single time it shows. Today, of course, they summarize. But this is a Google page from a year and a half ago. 315,000 references to this thing. It's all about assessing risk, not about projections of financial gain. And that's a different way of looking at a young company. It's about 4 elements. Each of them have a maximum valuation. So we try and put our value of the company based upon reduction of risk on these 4 different methods of looking at the company before its revenue. Now, you can say 500,000 maximum. During the height of the 2006 bubble, it got to maybe 750,000. If you go up to Silicon Valley, it may be $1 million max. If you go over to Oklahoma, where I made a lot of money on a deal, it may be a $250,000 max for each of these 4 things. Don't count the revenue number 5 yet. As you just heard from David, and you heard it from me, you make your money going in. And this valuation with each of these 4 elements becomes important because this is the value of a company going in to the investor, not going out to the buyer. So here they are. Let's reduce the risk. Number 1, the attractiveness of the core business to the investor. I mean, if this is a business that happens to be in one of those really hot fields today, it's going to mean that you'll get the maximum valuation. So say it's a robotics business, even though it's pre-revenue. Everybody wants to talk about robotics and AI, or lots of other ways in which brand new technologies, which are always changing over time, are hot at the time that the investor's looking. That would be a $500,000 beginning valuation. And then number 2, is the good management team in place? Meaning, is the management team capable of getting this company to break even? And if it is, that's a great management team. Beyond that point, turns out that the company is profitable, it is stable, and the risk goes way down. So if you have a great management team, you might give that $500,000 valuation. And if you have a management team that is first time or one entrepreneur operating alone, you may give a $100,000 valuation to the management team because the risk is high. Number 3, are there any strategic alliances reducing marketing risk? In other words, have you a buyer that says, if you build it the way you've described it, I will buy? Or if you have a supplier that says, I'm so excited about what you're doing, I'll give you 60-day terms. Any of those things allow the valuation to go higher because you're reducing the marketing risk. You are pre-valuing the company based upon other people's vision of what this company is worth. And number 4 is, have you completed the product itself or a prototype, even a wireframe, something you can show to others, and your technology risk is therefore reduced. So today, you can probably do this pretty easily with AI development, with low code, no code. You can do this with prototypes that you build, but if you have that and you can show it, reduces by far the development risk, and in some cases, depending on how far you've gotten with it, the technology risk. So put all four of those together, depending, as I just said, on your area of the country. And I will now add one more variable, which is the industry that you're in. Pharma is quite different in valuation. You would probably take strategic alliances off the table and put FDA clearance on the table in that number 3. And you can always change these 4 to fit the kind of business it is, and you can change the 500,000 to fit the geographic area and the industry that you're in. But it's a good thing to think that $2.5 million maximum or $2 million maximum valuation is great for the investor and really isn't so bad for the entrepreneur for these young early stage companies. It takes away the entrepreneur's belief that they're worth 10 million going in before they even have a chance to get in front of the investor. And it takes away the $10 million worry that the investor has to negotiate with the entrepreneur a number that is uncomfortable, way too high, and as I said earlier on, way too unprofitable with the average resale value. So let's not talk about revenue because that gets us back into the first 10. Stop right here. And David, make a comment before I show you a chart.
Yeah, I can go into a long, almost soliloquy on this, how important the valuation is. I'm not sure the entrepreneurs really understand what the Berkus method really is and how it can help them. Because a lot of the entrepreneurs that come in saying, well, look, if I'm an AI, I immediately start off with $10 to $12 million in valuation, which of course, may or may not be good because they may have only put in $50,000 in cash or, equipment. So I think what I look at, I kind of use a modified version of it in many ways. I may start off by looking at one of the other elements you showed earlier, and that is the benchmark, is what I call it, or comparison. And I know that companies in a certain space with a certain technology are running at around, just for like a normal curve, and here's the median, there may be around $5 million. What then I do is say, I go up or down based upon this attractiveness of the core business, the management team, if I have a really good strategic advisor, if I have KOLs, if I'm in the other business. Strategic alliances, even in the regulatory area, the medical device, med tech, are very critical because sometimes those alliances are actually contributing capital or resources to the entrepreneur, so that number bumps it up. The completed product or prototype, absolutely. I'm not investing in napkin drawings. I mean, that's a little too speculative even for me. And instead of revenue, I look at traction. That revenue may not be pure revenue. It may be LOIs, early pilots. It may be other things, for example, like non-dilutive funding. But when I really get down to it, I also ask the question of the entrepreneur, how much cash have you invested? And that tells me how solid a differentiation they have or how much money they spend to make sure there's a moat or sustainable competitive advantage they have in the market. So if somebody is, notwithstanding anything else, if somebody's saying, I put in $100,000 and now my valuation is 10 million when I come to you, my question is, are you really worth 100x of that today? So that's how I look at things. And then there's an overarching consideration. You kind of touched on it too, and that is risk. There's an acronym called PESTEL, PESTEL, political, which we have today, obviously, especially with tariffs, right? Economic, societal. You have that with TikTok, for example. Is there a risk in investing in businesses that are Chinese-based? Technological, very clear in terms of med device and even the AI area. Economic, and then legal regulatory. And the risk has to be factored in, because now you have to adjust the valuation up or down depending on that risk. So the point is, it's not easy to value things, but there are different methods. The best thing, and I think you pointed it out before, is you come up with the valuation based upon these variety of factors, and then you put a box around it. And therefore, you want to see if the valuation presented by the entrepreneur is within that box. But clearly, in pre-revenue, it's Berkus method or Berkus plus method, or the Berkus extended method, whatever you want to call it. But you have to start somewhere, and I think this is a really good starting point, whatever the level is that you're starting from.
So let's end with a graph, which we won't spend time looking at, but it does give you a chance to see developers on the left, governance, meaning the management on the right, the idea on the top. You can actually graph this, as one of my users did, and make it seem more logical as well. So
I like that, by the way. As an engineer, I like that kind of architectural structure.
Mm-hmm. So we'll end today's session by asking a couple of questions that can't be answered, but I'm asking the people who are watching or listening to us today to think about this. What do you believe your valuation is today? And how do investors respond when you give them that number? And have you received any term sheets based on that number? And how did you determine that valuation now that we've shown you the 11 methods we have? And what supporting calculations or evidence or comparables do you have to support your valuation? Those are great questions that we're going to leave with the entrepreneur, because it isn't just, I believe my company's worth 10 million. You've got to be able to back it up. And here are your ways of asking yourself and letting you kind of plan for how you're going to have to answer that when the investor asks. And David, that's the end of the presentation, and I hope you got something out of it.